In late June 2026, the Indonesian government paused a 5 million rupiah per unit subsidy for electric motorcycles. This marked the third consecutive time the policy had been delayed. On paper, the immediate logic was straightforward. The Ministry of Finance needed to protect 500 billion rupiah in state cash flow amid a severe macroeconomic shock. This chart overlays the 2026 state budget assumptions with mid-year market reality. The budget assumed oil at $70 a barrel and the rupiah at 16,700. When oil broke $100 and the currency spiked toward 18,000, baseline calculations collapsed, triggering a spending freeze. President Prabowo Subianto had previously given conditional approval for an initial quota of 100,000 subsidized units, but the deteriorating macro conditions forced the finance ministry to override that rollout. Halting the outflow looks like prudent short-term cash management, yet it masks a flaw in how energy policy is evaluated. By holding back a fraction of the budget, the state shifts those costs onto expensive fossil fuel imports, reinforces the grip of legacy manufacturers, and cedes a hard-won structural advantage to regional neighbors. What is framed as fiscal caution operates as a heavy tax on policy credibility, shifting the incentive structures of a nascent market. To understand the actual cost of holding on to that 500 billion rupiah, we have to look at the spending it was supposed to replace. This Sankey diagram compares the 500 billion saved on EV subsidies against the massive flow of fossil fuel subsidies, which swallowed 10% of 2023 state spending. By 2024, this burden reached 2.3% of GDP, the heaviest drag among top ASEAN economies. That spending doesn't stay in the domestic economy. Indonesia imports 25% of its crude oil and 30% of its LPG. The International Council on Clean Transportation projects that transitioning the domestic two-wheeler fleet to electric could save the public $5.8 billion through reduced reliance on imported fuels. Clinging to 500 billion rupiah in the short term allows for a continued bleed of billions of dollars to overseas fuel suppliers. The math fails the comparative test. The macro math is only half the problem. The erratic policy rollout causes immediate damage down on the market floor. Analysts identify a core mechanic at play here. Indonesia's EV sector is driven by the government, not the market. The state controls the demand signals. This diagram maps the resulting negative feedback loop. The government announces a future subsidy. Because they expect a discount, consumers freeze their purchases. When the implementation is delayed, that wait-and-see behavior craters wholesale and retail demand simultaneously. This leaves manufacturers holding massive depreciating stockpiles of inventory they produced in anticipation of a state subsidy that never arrived. When supply chains jam up like this, the manufacturers lose the economies of scale that naturally push battery costs down. The very cost reductions that would eventually eliminate the need for subsidies are halted entirely. Announcing and then withholding an incentive actively shrinks the sector and weakens its financial viability. If the EV sector is stuck holding inventory, someone else is taking those sales. Indonesia is home to over 130 million registered internal combustion engine motorcycles, with more than 6 million new units added every year. This market is highly concentrated. A single player, PT Astra Honda Motor, controls roughly 78% of all conventional sales. Electric motorcycles currently carry a significant price premium. Without state support, lower middle-class buyers who rely on two-wheelers for daily income cannot absorb the difference. Every month, the EV subsidy sits on a desk in Jakarta. Incumbent manufacturers sell hundreds of thousands of conventional units, expanding their distribution networks and pushing new, highly efficient models into the gap. In practice, suspending the EV rollout functions as an invisible shield for conventional internal combustion manufacturers, keeping disruptive technology priced out of the mass market. Zooming out to the regional level, the policy impasse creates a glaring geopolitical contradiction. Indonesia controls roughly 40% of global nickel reserves, the critical component for modern battery chemistry. Despite dominating upstream raw materials, Indonesia's domestic EV motorcycle penetration remains stagnant at around 1%. This dashboard compares that performance against regional neighbors. Look at Vietnam. Through multi-year tax cuts and integrated charging networks, they have pushed electric two-wheeler market penetration to 40%. Thailand has taken a different route, with its EV 3.5 framework, attacking the manufacturing side. They paired direct cash subsidies with strict local production mandates. If you import one vehicle, the policy forces you to eventually build 2 or 3 units domestically. That structure has pulled over 140 billion baht in investments across the entire supply chain, from cell manufacturing to final assembly. Thailand and Vietnam are building EV manufacturing ecosystems of the future without possessing Indonesia's nickel advantage. A 40-fold disparity in market penetration is a product of policy, not technology. Resolving this impasse doesn't require locating a massive lump sum of unallocated cash. It requires redesigning the architecture of the commitment. First, the state must abandon erratic annual budgeting for these incentives. A legally codified, multi-year framework provides the predictability needed to neutralize the wait-and-see effect and anchor downstream investments. Second, local content rules must be tightened, specifically around battery processing. Subsidizing units that are merely assembled from imported parts yields no industrial dividend. Tying subsidies directly to domestic battery processing bridges the exact gap between Indonesia's raw nickel reserves and its downstream manufacturing ambitions. Finally, there is the matter of geographic targeting. The Indonesian Transportation Society has proposed directing these subsidies toward remote and outer islands first. Consumers in those regions face drastically higher conventional fuel costs due to complex distribution chains. An electric vehicle there yields faster operational savings for the rider and steeper drops in state fuel subsidy spending. Combining multi-year frameworks, strict local content rules, and geographic targeting turns a vulnerable, year-to-year expense into a market-shaping regulatory signal. The core issue is no longer whether the Treasury can locate 500 billion rupiah in any given quarter, nor is it a question of industrial capacity. The crisis is a deficit of credibility. Global battery manufacturers evaluate risk across decades. When regulatory environments prove inconsistent, capital quietly diverts to stable shores. The decision to withhold that 500 billion rupiah creates an invisible outflow, effectively subsidizing fossil fuel imports, protecting legacy combustion incumbents, and funding the EV ecosystem scaling in Bangkok and Hanoi.